Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, September 25th. Nice volatile week this week in the equity markets. That's not often a combination you hear, nice and volatile. But it's important to recognize and differentiate between volatility and risk. Often people use those as synonyms in terms of looking at market activity. We like to use volatility to try to add to strong areas on weakness. We've seen weakness the last 4 weeks. S&P going into today was down close to 10% off of its early September highs. That creates opportunity. It doesn't mean you just buy and automatically the market goes higher. Opportunity doesn't work that way. But what opportunity does is start to shift the risk-reward scale in your favor. So some of the things we've been looking for are strong balance sheet names with strong return on equity qualities, greater than 15%, with bulletproof balance sheets. One of the securities we like to use in our U.S. core and our U.S. ETF portfolio is the First Trust Capital Strength ETF. It has some really nice highlights and features in it. First of all, company has to have at least $1 billion in short-term cash or short-term securities on its balance sheet. Has to have at least 15% return on equity. Has to have a less than 30% debt to equity on its balance sheet. Some very powerful ratios that start putting you in names that can withstand political turmoil, virus turmoil, social turmoil. Those are some of the names we look for. In our U.S. core portfolio, we added to FTCS, took our cash down to 10%. So in our U.S. equity and U.S. core portfolio, we're at 10% cash. Had gotten as high as 20, have whittled that back down to 10 into this sell-off, trying to stay in strong names. International core portfolio. EEM, emerging markets, had a tremendous run since March, has now pulled back 7, 8, 10% in conjunction with the stronger US dollar. Those two work opposite often. So as that pullback happened this week, we added to that portfolio, EEM. Tactical trend. Mentioned in the past, we had raised a slug of cash in tactical trend, now looking for attractive opportunities on this pullback. We found Alibaba as an attractive opportunity. Keep in mind, tactical trend focuses on 2 or 3 asset classes. With it being 75% U.S. domestic, we're trying to find some other areas. So we went into the China ADR Alibaba. Rock solid balance sheet. Almost 8% of their market cap is represented by cash on the balance sheet. 25% grower. Only trading at a PE level of 30. Always risk. What are the risks to Alibaba? What about the legislation discussing Chinese ADRs not being able to list in the U.S. unless more transparency is given in terms of financials? Very reasonable request from Washington. We'll see where we go with that. That is what's capping Alibaba right now. Outside of that, it trades very much in line with some of the powerful ratios that we saw 10 years ago in Google and Apple. Be interesting. So we took a 5% position there. Knocked our cash down to the 25% area. We'll continue to look. I told you I'd share a sector or industry that I need your help on this week. Life insurance. Life insurance companies. MetLife, Prudential, Lincoln National. They sell life insurance, annuities, group health benefits. Listen to some of these numbers that I keep going over. Let's take MetLife, for example. MetLife's trading at 45% of its book value. Whether you think book value is an important number or not, It is a traditional number in the life insurance and financial business. 45% of book value. Trading at 3 to 4 times next year's earnings per share. With a dividend yield in the, let's call it 5% area. Those numbers don't make sense. Those numbers can't make sense. What we have in the life insurance equity business, equity markets, is an argument, a bet that interest rates are going lower. We're at 65, 66 bips on the 10-year. We're at 140 or thereabout. John will fill you in on the 30-year. There is no way these life insurers trade at 3 times next year's earnings with 4 and 5 and 6% dividend yields in the face of rates going higher. What an argument we have here between the markets. Higher rates, more spread business for the life insurers. All that premium that gets invested, they need higher rates. Lower rates really constrict their business. So give me your thoughts on that. It's a great puzzle. Will we see higher rates and see these life insurers start to expand market cap? Could be a dynamic trade. Or is the equity market right? And although rates are low, they are going to go lower. Let's listen to what the Moose has to say. He'll give us his take. We'll watch those life insurers. I'm not a guy that tends to get excited about true value stocks and sectors, but you cannot look past this opportunity if we're talking about a 1% 10-year, a 125 10-year, a 2.5% 30-year. These companies will trade back to 8, 9 times next year's earnings. That's a heck of a lot of performance to ignore. So we'll keep an eye. If you have any thoughts, share them with me, and we'll see you next weekend.
Hi, it's John Mousseau. I am the President and CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon, September 25th. Quick wrap up in bonds. Somewhat of a quiet week in bonds. Yields down slightly, prices up. 10-year bond yield down from 0.69 to 0.65. 30-year bond yield down from 145 to 140. Muni yields on the high grade, maybe 15 basis points higher than that. Very quiet week in munis, really no change at all in the scales. As we get closer to the election, this is expected. We've seen it before. Get jitteriness of the election. We've seen jitteriness in the stock market 4 weeks in a row with, even though we closed on a decent note today, 4 weeks in a row of more or less declines in prices. This is the kind of jitteriness you always see before a presidential election. It's reflected in the bond market with slightly lower yields and slightly higher prices. Initial jobless claims this week came in a touch higher than expected, but still under 1 million. Continuing claims a little lower than expected. That's a good sign. New home sales rocking, just continues to rock. You look at the muni market, some very encouraging signs this week in the sense that you had issuers such as the Portland Airport Authority and the Chicago O'Hare Airport, which I mentioned a couple weeks ago. I was in not too long ago, and it was doing quite well in terms of people flowing through there. They came with over $1 billion deal. Those deals got done, well oversubscribed, not the lunatic fringe oversubscription, but solidly oversubscribed, showing you that if there's a little bit of give in the market, there are buyers there for it. And if you think about airports being certainly not the worst of the pandemically affected issuers, we know there's lots of people that are worse when you start thinking about things like convention centers or stadium issuers, things of that nature. But clearly airports have a lot of wood to chop before they get back to normal. But doesn't seem like they have any problem getting access to the bond markets, and that's a good sign. And as we said, as we get through the fall, we expect to see more issuance. We expect to see some troubled issuers come to market. That includes the state of New Jersey. and we expect they will find access to the capital markets. And as we get closer to a vaccine, the ability to access the capital markets is so important for municipal issuers. And closing on one little bit of good news, it looks like perhaps that Steve Mnuchin and Nancy Pelosi are hammering out an agreement that will lead to a stimulus bill, which will clearly include aid to state and local governments. And we think that's a very good thing. We hope you all have a good weekend, and make sure that you watch the presidential debate next Tuesday. Have a great time.